Okay, I am here to show you guys by popular demand how I trade Bitcoin. So what I'm going to do is remove all the drawings I have, and we're going to review some charts. So what I do, I start off, I always have sessions on. I always have sessions. If you don't know what time session it is, and you don't know what period of the day you're trading, or what side of liquidity delivery you're on, you're wasting your time. You're going to lose more than you win just because you don't understand where the market is moving. And you find that through sessions. If you haven't put the time in on looking at the market with sessions, pause the video and go do that. Because you are actually fooling yourself if you don't use sessions on your charts. I swear to you, it is the best indicator you could use. Period. At all. You could just use sessions. This is a PSA right now for sessions. If you're not using sessions, get on the train with sessions. I don't know what you're doing. But yeah, just get sessions, dude. Come on. Okay, yeah. So we are first looking at sessions. What time session you're trading? We're trading Bitcoin, so Asia is going to be hot and New York's going to be hot. London I find to be somewhat stagnant or trend continuing. They kind of like they pick up off what Asia does, but for Bitcoin I always found Asia and New York to be my hot times for trading and finding the market movements. And now with this, we're looking at the waves. We have default waves on right now, looking at 5-minute chart. And what the waves are telling me is we had convergence back here, and it looks like we're cycling down. We're in kind of this slow downward channel. We're cycling through volatility. We're having these long spouts of low volatility to a sweeping high volatility. And we're just continually trending down. Now zooming into here, what we see is the 15-minute cycling, the 1 hour coming into this middle ground, holding it and moving lower. And what we have is a really low 15-minute wave. So in this whole day was a down day. And what we're looking at is the 5-minute pullbacks. Because look at this. We have all the waves down here. All the waves down there are pulling price down. But yet we get this miniature 5-minute pullback at the London Open. You want to take that trade. Why are we taking this trade? Well, we're coming from lower volatility into high. So we can expect lower volatility to come out of high. Low volatility brings steady moves, generally. And with that, we have the waves down with the 5-minute pullback. But when we're in this area, no, we're going to want the brush. When we're in here to here, whoop, that's when you drop to your lower time frame. Because what are we expecting when we see this? We're expecting the hook back. Because again, we're expecting downward pressure. We're in a downtrend. We have downward motion. We have downward momentum. And if you haven't been under a shell for the last, 3 weeks, crypto is going to the dumps. I mean, everything's dumping. So to have a bearish bias on crypto right now, not out of the norm. Okay, so now that I got that out of the way, we drop down to the 1 minute at June 12th, 22. Yeah, June 12th, 22. June 12th, 22. Here we go. So here's that area. And now we were getting our entry over here on the 5 minute. But what we see on the 1 minute is the actual start of that hook, of that 5 minute reversal. So this is the trade I would be taking. Very different in risk reward. The last trade yielded around 1 to 2 for that first swing. Here we're looking at about 1 to 5. Going the full way with it, you can gain a lot more by trading this way. Trading with the momentum of the waves. Trading on the side of where the trend is. Trading on the side of the volatility. Some days you are going to do everything right. Trade on the side of the volatility. Trade on the side of the waves. Like this, maybe you took this trade here. You take it, maybe get stopped out break even. You take this trade here, thinking, oh, this is good. It's going to start to hook. You take it, you think it's great, you get stopped out. That's going to happen. There's days like this. But the days where we get these days, where our trades go no drawdown, where our trades move 1 to 5 in the first half hour. Those are the trades that we like to be in. Those are the trades that we like to hold. This whole run was 1 to 16. So if you're losing 1%, half percent, break even on days like this, but then you turn around and go knock out a trade that's 1 to 10, you think the 2% you lost over here matters? When you're pulling a 1 to 10 over here, and then even here you can get a pullback entry. Even over here you can get another pullback entry. And let's even go examine this, just to further the point of, you're going to lose on the days that look like this. It's going to happen. It's going to suck. You take 3 trades that line up perfectly, and they all smack your stop loss. But you just got to take a break, come back on the next cycle of the day. Because remember, everything is a cycle. Everything. The volatility, the liquidity, the delivery of price. It runs on time sequences. It runs on volatility models. It runs on statistical models. It runs on news models. And all of it runs on cycles. 22-day cycles, moon cycles, credit cycles, interest cycles, inflation cycles, data cycles. Everything runs in cycles. So when you get in the deviated second or third deviation of the mean is the expectedness that we like to see. Because 95% of our data that we trade is going to be within the mean of expectancy. But when you get days like this that are outside that second deviated mean, and if you don't know what I'm talking about a normal bell curve. You have the middle, the first deviation, second deviation, third deviation. All of our trades are going to line up in this first area, first 2 areas. That's 95% of the data. These days are part of the 5% of the data on each side, the 2.5s. And even past that is like the 0.1% of the data. So these are the days that we're going to lose, inevitably. It's going to happen. This went from volatility and me telling you how I trade to a pep talk. But this is what you need. Because if you're losing in the markets using these tools, you need me. You need me to smack you around. You need me to give you a pep talk. So, these days suck. Yes, get over it. It happens. You lose money. That's why we're here. Because losing money gives you money. You're making money work for money. These are the days that you go smack out some winners. We already went over the trade that yielded 1 to 16 over here. We get this pullback over here. And we're going to line it up from here to here. And hell, we're even going to go with here to here. Because we're proving points today. Okay, so that area that I just highlighted is that 5-minute pullback zone that we're looking at. Waves are down. We get a 5-minute pullback, which results in the local wave being inside this zone. As soon as we see that, we go down to the 1 minute. Well, what's the 1 minute telling us? Okay, the 1 minute tells us that we're currently at a kind of highish volatility. We can expect volatility to move down. Even looking at the directional expectancy, the historical volatility is peaking at like 84. That's high. We can expect it to contract. So we get this. This is our line that we had marked out on the 5 minute. And then look, we get our 1 minute entry. 1 minute entry here, confirmed on the trend bars as they flip. Stop loss above the high. And you can run with it. So we had 1 to 16. We could have banged out another 1 to 7. Easily banged out another 1 to 3. Super easy. But then if you hold it, you could have got like 1 to 7, 1 to 8. Now, and to the second point of interest. We come up here. We're in our 5-minute zone. We flip. We flip, there's our entry. Even if you use that or that, you would have got stopped out. But that's okay. Because what happens right after? We get another opportunity. And sometimes when you have these instances where it's taken a longer hook or a higher slide, sometimes you have the double or triple knockout trades where you take one, it gets knocked out. You take the second, it gets knocked out. That's when you have to decide, is this still going with your trade management? Is this still going with your risk management? Are you trading within the time frame that you should be trading? That's when you start to ask yourself the questions, because if you're hitting these trades and you're getting knocked out of each one, you gotta start asking yourself, are you following your trading plan? Are you reading the waves right? Are you understanding the risk that you're putting on? And the expectancy of these trades. Are you looking at it unbiasedly? Now here for the second one, I would have still taken it because, again, the way I trade, I stack my positions as I go. So I could already have been partialed out of the first trade and I could have had some left on, which makes me more confident in taking a second or third trade on a kind of slide like that where I might lose one or two but then finally hit. But when I hit, it replaces those trades that I lost and some. Because we trade, the way I trade, tight stop losses, high risk rewards, certainty in the moves. I want to see certain things happen fairly quickly, or else I'm out of the move. And even at that, the ways that we trade with ProWaves and volatility and the cycles just lines up perfectly. So now this second trade, again, stops above the high. And again, another easy 1 to 3. So 1 to 3, 1 to 7, so we're up 1 to 10, plus a 1 to 16, 1 to 26 in a day you could have got. Well, here you were crying about losing 2 or 3%, you could have been up 26% over here. Put in your total for the 2 days at 24, 23, hell, even 20% if you were taking partials or weren't able to execute the full things. Or even got some late entries, or added some extra on your stop losses. 1 to 15 even for the total, if you're really being generous on the slippage. But the way that you trade is you want to line up with these sessions. You want to line up with the ProWaves. You also want to look at things like fair value gaps. Are we respecting a fair value gap as we're coming down? Are we traded into a point of interest? The way I trade is very, very scoped down. I trade very fast, and I trade 15-second charts for Bitcoin, and the fair value gaps that happen within these, and just the little, you gotta find the synchronicities with the ProWaves. And to really simply put it, you just need to use the system. You know the theory if you've watched the training videos. If you don't know the theory, go watch the training videos, because that will give you better understanding on how to read waves, on what market structure is, on all the things that I've been mentioning. The videos will teach you that. Everything else about the system and how you get good with it is made while you use it. You have to be scientific with it. You need to get your hands dirty. You need to start to demo trade. You need to start to test things out with it. You need to start to look over previous data and previous days with it. You need to look over your previous trades that you took without it to see what the waves were doing. You want to start to look for things within ProWaves, within the volatility, within the day-to-day sessions, and try to exploit those things you find. I can't give you the sauce, because the sauce is different for everyone. What works for me might not work for you. What works for you might not work for me. But things synchronize over a level, and you get a fair playing field when you start using the premium quality tools, because they give you a different level of confluence on top of how you already read the market. The tools provided are universal. How you trade with them are dependent on your style. I trade high risk. I usually risk around 3 to 7% on my crypto futures account for my high risk account, but then for my actual swing trading account and normal trade, that's a 1% risk per trade. But in my high risk, I'm doing 3 to 7. It's not for everyone, but I like it. Works for me. I do really good with it. You might not, or you might. You might be the type of person to only risk 0.25% per trade, but still knock out 40, 50, 60% return months. You could be the person who risks 2% a trade and knocks out 40, 50, 60% months. It all depends on you, your trading style. Figure out what you like to do, use it with the system. The system will give you uncanny insight to how the markets run. And if you learn it a certain way, along with smart money concepts, you can start reading the liquidity and the volatility that run through the market. And that gives you just the ultimate edge on how to read the market and trade. But I've rambled enough. This is my video for how I trade Bitcoin. I will do more of these and trade reviews, like the trades I've taken. I'll go over them, what I seen, why I took it, what my stop loss was, why I used that stop loss, and we'll go over the whole thing. I will do that more. As for these style of videos, I will be going over more ProWaves stuff and maybe even some market outlooks, market reviews. But overall, use the tools and use sessions. And if you don't understand, ask questions. And if you still don't understand, ask more. And if you still don't understand, look at the videos more. And if you still don't understand, I'm going to say, have you been practicing? Have you actually been using the tools on the charts? Have you been showing up to the charts every day at the same time? Are you showing up late to the charts? Are you taking your chart time serious? Are you recording your chart? Are you taking journal trades? Because if these tools aren't working, you're not working. Simple as that. If you can't make money with these tools, you're not willing to make money. It's really as simple as that. And I'm going to end it on that note.